James, thanks for joining us. Turning first, the performance of the funds. What did we see in April?
Well, April again had its challenges, shall we say, but by the end of the month, the equity market's up over 3%, and the Harmony funds benefiting from that, all posting positive absolute returns in the month of April. Interestingly, in fact, over the last 12 months, all of the funds are in positive territory as well, and so this is a pleasing period for the funds. Big regional differentials, we'll speak more about that later, but there was lots going on sort of underneath the bonnet, if you like, to drive those returns. And in periods like this, as we've said before, year to date, where risk generally is being quite well rewarded in the funds, you would expect us to start dropping off against the peers slightly over the short term, on the basis that the Harmony funds are built to be a fund for all season. They're meant to be a core sort of bedrock of a portfolio, if you like, and so in times such as these, we expect the higher beta, the higher risk strategies to start to sort of pull away, but we understand that over the long term, the consistency is key to being up at the top end of the peer group, really.
Great stuff. And the main asset allocation drivers behind performance last month?
Well, the equity element was the most important. It's been well rewarded by the markets presently to take on that level of risk in your holdings. That is a major holding in all of the Harmony funds, despite the fact we've trimmed it relatively recently, as we've mentioned before. There's reasonable regional differentials again within even the developed markets. Japan being the standout market, of course. Significant double-digit returns from that region in a single month, and certainly over a longer period as well, as Abe's reforms are really being well rewarded by the market. Interestingly, global emerging markets, though, underperforming the developed markets, so luckily we've been lower in those assets than perhaps we have been in the past. We thought the emerging markets were getting a bit ahead of themselves last year. We trimmed that position, and so while we have some emerging markets position in the Harmony funds, it's actually less than it could have been, certainly. The Japan returns, I should also say, clearly most impactful to the Asian funds, where they've got sort of the largest Japanese exposure. Turning to the fixed income markets, global government debt actually provided decent low single-digit returns again. The Harmony funds don't have large explicit positions in government debt, so they're not going to benefit from that in a sort of direct sense, but how they will benefit is from the second iterative of that move. The credit markets have priced off those government bond securities, and so as the reference rate moves down, that provides a bit of a tailwind to performance for assets like high yield, like convertible debt, and even investment grade debt as well. So while we're underweight the government side, we're low in what we think to be a very overvalued asset class. We have still got exposure to the likes of investment grade debt, convertibles and high yield debt, as well as strategic bond managers, which are all investments we think are more likely to do well on a through the cycle basis.
Focusing on Japan just for a minute, James, we've seen the equity market move up. That has obviously been accompanied by the yen moving down. Does this mean the Harmony funds have missed out to an extent through currency translation effects?
We've actually aimed to mitigate that exposure to the yen by taking on, where we have taken direct Japan exposure in the equity market, by hedging out the currency back to the US dollar, on the basis that while the Japanese equity market has been attractively priced, we've thought the yen actually is overvalued. And the other important thing about the Japanese market, as an industrial sector highly reliant on exports, clearly you're likely to do well when the yen sells off. If you have the belief that the Japanese market is going to do well, particularly in these circumstances where the yen was expensive, you're likely to not want to have that yen exposure as well, and that's exactly what we did.
Excellent. Did you elect to make any major changes to the portfolios last month?
To be honest, it was a reasonably quiet month in terms of portfolio changes. As we've noted in a couple of these videos now, we've started with taking the risk off the table slightly in these funds, and we continued to hold that position through April. So while the funds have gone up a decent amount in the month, the position looking forward is one of a little bit more circumspection with respect to the global outlook. So Treasury inflation protected securities and index-linked gilts, where we held those. We've taken those positions off because we thought they were getting quite expensive, actually. As you'd expect, the rest of the government bond market has done so, but those securities hadn't been pricing in much inflation in their respective regions, and so we thought there was a small opportunity there, which we did exploit, and we've now taken profit on that. There'll be a time for those assets again, but as of today, they're not really representing particularly good value against government bonds. And the other small move again is within the fixed income position again, trimming back on our duration in the high yield space as well. Historically we've had more of the sort of moderate to full duration high yield exposures, and we've been moving that towards a low duration high yield exposure on the basis that you don't really get adequate additional compensation for taking on that duration, that interest rate risk. So you may as well stay in the shorter end of the curve and get a pretty much identical spread actually in the shorter duration securities.
And looking forward, James, into May, into June, what do you think investors can expect?
Well, we mustn't be too short-termist, clearly. As I say, we are positioned in the Harmony funds for a period of consolidation. We do think that's due, and as these markets continue to run up, we think that is not reducing the likelihood of that impact, or not reducing the likelihood of that event, in fact. Having said that, interesting statement from the Federal Open Market Committee, the Fed, last month, to the extent that everyone's been talking about the winding in of QE, tapering as it's called often, and which clearly is a sign of bullishness in the sense that the implication is that it's less needed to keep the economies on a sort of even keel. Interestingly, the minutes there essentially made the point that don't just think about tapering, also bear in mind we will continue to add to these kind of extraordinary liquidity measures if that's required. So although that's a positive message for investors in the sense that the official sector is still going to help you should it be required, the fact that the Fed felt it was necessary to say that, the subtext is quite negative there in the sense that we are still ready to throw more money at the problem if the problem arises. So we shouldn't assume that all the world's problems have been solved, even though the market's gone up very significantly over the last 6 months. So, as we've said a number of times, without sounding like a broken record, there are reasons to be positive, but there are plenty of macro and policy risks still in the mix. And while equity markets are pretty fairly valued over a medium-term view, and to that extent we are constructive on equity markets over a decent holding period, over the shorter term we think markets are due a period of consolidation, and it may well be a macro style or policy style risk that triggers that, but we are confident over the medium term that equities are a decent investment actually.
James, with equity markets in many regions registering new highs, we've said we're looking possibly for a period of consolidation. Where then will the Harmony funds either look to protect investors, or where will we be, still finding value effectively?
Well, the protection has come in it is built in a number of ways. Within the equity allocation, we've got diversification through regional exposure and through style exposure as well. So we've got a large proportion of our equity holdings in quality managers, for example, which should be lower beta holdings than the broader market. We also do it across asset classes. So within the fixed income, fixed income is in itself a diversifying asset to an extent compared to the global equity markets, and so having fixed income in the portfolio should reduce our sensitivity to that equity market sell-off. Having said that, we have a fairly high proportion in high yield convertible debt, which is more akin to the equity market than some other elements of the fixed income market. But they are still diversifying assets to an extent, and we think fundamentally cheaper than global government bonds, and that's another risk reduction tool we can use as investors, is make sure you're holding assets which are good value, as opposed to assets that are diversified but expensive, in the sense that the value will, we believe, protect you in the long run much more effectively than perhaps expensive assets might in the short term. So it's that trade-off in the portfolio. The final position we're taking, which is arguably a defensive one, is our cash holdings, which are reasonably high today. And cash is a very dull asset today, but what it does do is protect of capital, and it doesn't, while the yields are low, in some ways it's less expensive than the government bond market. So there's an opportunity there for us to have dry powder, protect on the downside, while those assets won't go up as risk or nervousness increases. It will stay steady, and then we can put that in the markets opportunistically as we see value revert to more attractive levels in the markets.
James, thank you very much.
Thanks, Richard.